Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Picture this. You're looking at a company's financials. The balance sheet looks, pretty clean. Debt seems low. Ratios are solid. Everything looks okay.
Right.
But then, way down in the footnotes, you spot something about operating lease commitments or maybe a joint venture obligation. And suddenly, that nice, clean balance sheet doesn't seem quite so straightforward anymore, does it?
Exactly.
Okay, let's unpack this. Today, we're taking a deep dive into the hidden world of off-balance sheet financing.
And what's fascinating here, I think, is that this isn't automatically bad, Sometimes it's actually smart capital structuring. It's a strategic move.
Okay.
But as we'll see from the sources, sometimes it's, downright dangerous. It's designed specifically to hide the true financial picture, the real leverage.
Right, hiding the risk. So our mission for you today is to really get a handle on what off-balance sheet financing is, why companies use it, and crucially, how to tell the difference between legitimate uses and, the kind of abuse that can get companies into serious trouble.
And how finance pros, or honestly, anyone who's really curious, can spot those risks.
Exactly. And we've got some really interesting real-world examples lined up, some pretty infamous pull from the sources you shared. So let's start simple. We're talking about keeping things off the main books. What exactly is off-balance sheet financing?
Well, at its heart, it refers to arrangements companies use to keep certain assets or liabilities off their primary financial statements. Off the balance sheet, specifically.
Okay, so it's like having, a big backpack full of important stuff that doesn't show up in your official luggage count when you check in for a flight.
That's actually a great way to think about it. Yeah, it's there, it's important, but it's not immediately obvious on the main tally.
Gotcha.
And the sources highlight a few common ways this happens.
Like what?
Well, leases were a huge one historically, especially operating leases. Before the new accounting rules came in, things like IFRS 16 globally and ASC 842 in the U.S.
Right, those big changes.
Yeah, before those, operating leases often didn't show up as debt on the balance sheet. They were just treated like rent expense.
So a plane lease for an airline wouldn't look like debt?
Not directly on the balance sheet, no. That's largely changed now, but historically that was very common.
Okay. What else?
Then you have joint ventures or JVs and other kinds of partnerships.
Right.
So a company might partner with another entity for a specific project. That joint entity might borrow money, but because the parent company doesn't fully control it, they might not consolidate all that debt onto their own balance sheet.
So the debt stays kind of over there with the JV.
Sort of, yeah. It depends on the accounting rules and the level of control, but often it doesn't get fully rolled up. And then there are special purpose entities, or SPEs.
SPEs. Those sound kind of intriguing. And maybe a bit dodgy.
They certainly can be dodgy, as we'll see. But basically, they're separate legal structures. Companies set them up for specific reasons, maybe a single project, or to isolate certain risks, or yes, sometimes to handle financing off the main books.
Okay, so different tools for different jobs, potentially. But why? Why would a company want to do this? What's the incentive?
Good question. There are definitely legitimate reasons. For one, it helps manage leverage ratios. If you keep debt off the balance sheet, your reported debt levels look lower.
Which makes the company look less risky.
Exactly. It can potentially mean lower borrowing costs, maybe keeps you in line with debt covenants. Those are the agreements with lenders about how much debt you can have.
Okay. Don't want to break those rules.
Definitely not. It also allows for flexibility. Take leasing again. It lets a company use an asset like a building or equipment without a massive upfront purchase.
Frees up cash.
Right. Preserves cash for other things. And then, let's be honest, sometimes the motivation is, just to make the numbers look a bit prettier than they really are, to maybe obscure the true level of risk.
Okay, so that's the spectrum. Smart strategy on one end.
And potentially deceptive accounting on the other.
Right. This is where it gets really interesting, isn't it? The tool itself isn't necessarily the problem, but how it's used.
Yeah.
Can you walk us through some examples? Where's the line between legitimate use and the darker side?
Absolutely. Let's start with the legitimate side. Leasing, as we said, is a classic. Think about airlines. Companies like Delta Airlines historically relied very heavily on operating leases for their planes.
Makes sense. Planes are expensive.
Incredibly expensive. So leasing allowed them to manage cash flow, scale their fleet up or down more easily, and avoid tying up billions in capital buying every single aircraft. It was just smart fleet management.
Okay, that sounds perfectly reasonable.
Yep.
And you mentioned Starbucks, too.
Yeah, similar idea, but with real estate. Before the accounting rules changed, Starbucks used operating leases for thousands of its stores globally.
All those coffee shops.
Exactly. It let them expand super fast, get into prime locations without buying the property, and stay flexible. Again, standard practice, very strategic. The new rules just brought more transparency to those existing commitments.
Got it. So leases can be very legitimate. What about joint ventures?
Also very practical. Imagine, say, a big oil company wants to explore in a risky new area. They might partner with a local company.
Share the risk.
Precisely. They form a JV. The JV might take out loans for drilling rigs, exploration costs, whatever, but that debt might stay largely within the JV structure, not fully appearing on the major oil company's main balance sheet. Again, perfectly legitimate if it's disclosed properly. It's about risk sharing.
Okay, so we see the good side, but we know things can go wrong. Where does it tip into abuse?
Well, the textbook example, the one everyone points to, is Enron.
Right. I was waiting for that one.
Yeah. In the early 2000s, Enron became infamous for its abuse of special purpose entities, those SPEs. They used them aggressively to hide enormous amounts of debt and failing investments.
How did that work exactly? What were they hiding?
They created hundreds of these complex, often deliberately confusing SDEs. They'd then sell assets that weren't doing well, like stakes in international power plants or their broadband business, to these SPEs.
Sell in quotation marks.
Definitely quotation marks, because the SPEs often borrowed money to buy these assets, and those loans were frequently guaranteed by Enron itself, so the risk never really left Enron.
Wow. So it just looked like it was gone.
Exactly. It allowed Enron to report higher profits, get bad assets off its books, and crucially, keep billions in debt hidden from investors. On paper, they look like this incredibly innovative, fast-growing energy giant.
But underneath?
Underneath, it was a disaster waiting to happen, a house of cards, really, built on hidden debt. When the market finally started asking tough questions and the truth came out in late 2001, well, it was catastrophic.
Billions lost, jobs gone, the company collapsed.
Total collapse. It became this massive scandal, led to new regulations like Sarbanes-Oxley, and it's still taught today as a stark warning about opaque accounting and corporate greed.
Chilling stuff.
Yeah.
So Enron is the prime example of abuse. Let's contrast that again. You mentioned Delta's leases were strategic. What happened when those new accounting rules did force those leases onto the balance sheet?
Well, for Delta and pretty much the whole airline industry, it was a significant change. Suddenly, billions of dollars in lease obligations appeared as liabilities on their balance sheets.
So their reported debt levels jumped.
Dramatically in many cases. Debt-to-equity ratios shot up overnight. It gave investors a much clearer and arguably more accurate picture of the airline's true financial leverage. It didn't mean leasing was wrong, but it meant the financial impact was now fully visible.
Okay, so transparency increased significantly. What about General Electric? GE Capital often gets mentioned here too. Was that like Enron?
Not exactly like Enron's outright fraud, no. GE Capital was GE's huge finance arm, involved in everything from lending to leasing. They used complex structures, including some off-balance sheet entities, to fund these operations.
But it wasn't necessarily illegal.
Not necessarily illegal, but incredibly complex and opaque, especially after the 2008 financial crisis. Regulators and investors became very concerned. It was just hard to understand the true risks embedded within GE Capital because of this complexity.
So the complexity itself became a problem, even without clear fraud.
Yes, precisely. It eroded confidence because people couldn't easily assess the risk. That led to regulatory pressure, and eventually GE significantly downsized GE Capital. It shows that even technically legitimate structures can be problematic if they aren't transparent.
Interesting. And then you mentioned REITs, real estate investment trusts, using JVs transparently. How do they do it right?
REITs often partner up to develop big properties, shopping centers, office towers. They use joint ventures, which might take on debt.
Okay.
But the key difference, and what makes it generally accepted, is disclosure. Good REITs are usually very clear in their financial statement footnotes about their JV commitments, any guarantees they've provided, the JV's debt levels.
Because they spell it out.
They spell it out. Investors can see the obligations, assess the risk. It's not hidden away like it was at Enron. It's about transparency.
Okay, so pulling this together, it really sounds like the specific tool lease, JV, SPE isn't the main issue. It's about why it's being used and how clearly it's being disclosed. Is that fair?
That's absolutely the core takeaway. Intent and transparency. Is the goal genuine efficiency and risk sharing, clearly explained? Or is it obfuscation and making the numbers look better than reality? That's the crucial dividing line.
Right. That makes a lot of sense. So for anyone listening, maybe they're looking at investing or analyzing a competitor or even just trying to understand their own company better. What are the practical things to look for? How do you spot potential risks?
Okay, this is where the detective work comes in. Number one, and you absolutely cannot skip this, read the footnotes. Seriously, dig into them.
The fine print.
Exactly. That's where companies have to disclose details about leases, guarantees, JV commitments, contingent liabilities. The real story often lies buried in those notes.
Got it. Footnotes first. What else?
Second, remember that off-balance sheet doesn't mean no cash impact. You need to look at future cash flow commitments. Does the company have huge lease payments coming up? Obligations to fund a JV? Even if it's not on the balance sheet as debt, it still requires cash.
So map out the future payments.
Map them out. Assess liquidity. Third, when you do your own analysis, think like an economist, not just an accountant. Treat things like significant operating leases or those take-or-pay contracts as debt equivalents.
Take or pay. What's that?
It's a contract where a company commits to buy a certain amount of product or service, like energy capacity, for instance, and they have to pay for it whether they actually take it or not. It's a fixed obligation, very much like debt.
Ah, okay. So add those kinds of things back in when you calculate leverage ratios.
Yes, to get a truer picture. And finally, be wary of highly complex structures, especially SPEs or unconsolidated entities that seem overly convoluted or involve related parties, like managers having a stake in the SPE, as with Enron. Complexity can be a red flag all by itself.
If you can't understand it easily, maybe that's the point.
Sometimes, yes, it warrants extra scrutiny at the very least.
This is super helpful. So the big takeaway seems to be, don't just look at that main debt number on the balance sheet. You have to actively look for these other obligations, adjust your own analysis, and maybe even stress test the numbers to see the real financial health.
That's it in a nutshell. Look, off-balance sheet financing isn't disappearing. It can be a really useful tool for companies when used strategically and transparently.
But the potential for abuse is always there.
Always. Enron is the ghost that haunts these discussions for a reason.
Okay, so key things for you to remember from this deep dive. First, know the common forms leases and their history, joint ventures, special purpose entities. Second, learn to look for the intent and transparency to separate legitimate strategy from aggressive accounting.
Crucial.
Third, always, always, always read the footnotes. That's where the details live.
Cannot emphasize that enough.
And finally, adjust your own view of a company's debt. Add back those significant off-balance sheet items to get a realistic picture.
Absolutely. Anyone making decisions based on financials, investors, managers, analysts needs to understand these nuances. Bringing that deeper understanding, spotting those hidden risks, that adds real value. It's about seeing the full picture.
So next time you glance at a company's seemingly perfect financial statements, pause for a second. Ask yourself, what might be lurking just off stage in those footnotes or complex structures? What else do I need to see for the real story?
Because remember, whether you're assessing risk, making an investment, or managing your own company's finances, what you don't see directly on the balance sheet really can impact you. It pays to be diligent.
Great advice. Until next time, stay sharp, stay curious, and keep aiming for that financial clarity. Thanks for taking this deep dive with us.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.